Now I am selling AT&T. It is one I have had in my portfolio for many years. And in today's episode, we are going to analyze this. I'm going to run through some of the points that I do not like for AT&T in the future. I'm also going to point out some of the positives of this company. And at the end of the episode, as always, we will run it through our valuation model, looking at that intrinsic value and getting to our acceptable buy price given that margin of safety. Now, year to date, it is down around 14%. And if we look over the last month, we can see it has rallied slightly up around 6.51%, up from their 52-week low of 13.43, although it is still trading towards the mid to lower end of the 52-week range. It does offer a yield of 6.86%, and as we can see for investors who have been holding the company over the last 10 years, you would be down around 39%. We can see the peak of the last 10 years sitting around $32. Now, we're going to analyze this company as usual. We are going to go through their income statement. We are going to look at the health of the company, their total cash versus their total debt. Very briefly touch upon some of their competitors in the industry and how they've performed, as well as what the institutions are doing, and taking a look at that all-important dividend safety. And I will run through some of the metrics that I do not particularly like, as well as their latest earnings. So jumping straight into their income statement now, obviously we do like to see 3 to 7% growth year on year with any company. It is slightly difficult to analyze AT&T given they did spin off the Warner Bros. But what we can in fact see that over the last 5 years, their top line has gone down from 170 billion to around 120 billion. Now, it will be better analysed when we do get there December 2023 to see how they have compared to a full year without this essential spin-off, and therefore we are better positioned to analyse how this company has performed. If we do take a look at their bottom line net income, what we do in fact see is this has gone from around 19.4 billion in 2018 to a loss of 8.5 billion. So again, this is something we will touch upon when we have their full 2023 annual report to then be able to better analyse the movements over the last few years. Now, in terms of how they're doing health-wise and their cash position versus their total debt, well, they held around 5.2 billion in 2018, and this has increased from their latest quarterly report to 7.6 billion, which is positive to see, but it's also important to see the numerical direction of their essential total debt. Now, this has gone from around 179 billion to 163 billion, so it is positive to see that they have been paying off that debt. It has come down quite significantly by around 16 to 18 billion, but in actual fact, that is still a large amount of debt for any company to hold, especially when you consider that versus their total cash. Although a lot of people will argue for essential telecoms industries, they do need to hold onto this debt for many reasons. But personally, this is an off-putting decision that I was keeping for quite some time, just because it does hold a lot of debt in comparison to their total cash. Now, the reasons why that's important, I will touch upon when we look at their metrics. And in terms of how their performance been, well, year to date, it is fairly obvious this stock has been hammered. In fact, the worst performing of their competitors, we do see it down negative 8%. We do see Verizon essentially flat. And then when we expand this to essentially the last 5 years, and remember, where possible, do expand your data, we can see they are relatively only up by 1.4%. Now, that is pretty poor, especially when they do offer such a high yield. You would expect this to be significantly higher. But they have outperformed Verizon, but that shouldn't really be a reason for an investment. Though I do always say past performance is never indicative of the future. It is just one area that I do believe AT&T has lacked in the past. And unless there is a major change over the next year or two, then it does seem likely that their performance will be quite lackluster. Now, in terms of the institutions, what we do see around 54% institutional ownership, and we see around 6 billion worth of institutional outflows, sales shares over the last 12 months. Now, when we do compare this to inflows, we do see this up around 24 billion. So investors do like AT&T, the institutions love them. We can see they have significantly bought more shares than selling, with a large portion of this being in Q2 of 2023 at 15 billion versus 1.43 billion sold. As always, though, do remember, and I always emphasize this, we shouldn't be copying what analysts or institutions are doing. We should always be doing our own due diligence. Now, before we touch upon that dividend safety and that borderline safe score, we can take a quick look at their last earnings for their September quarter. Now they did beat on the earnings per share at 62% expected versus 64 cents essentially reported, so that was a 3% surprise. Top line, what we did see another beat, 30.23 expected, 30.5 billion reported, so they did beat their top line by 120 million. But the interesting thing is when we compare September 2023 to Q3 of 2022, whilst we do see their top line up around 1%, their bottom line is down 42% from the same quarter year on year. Their earnings per share down 40%, their net profit margin down, and their operating income down, as well as that net change in cash also going down. So just a few factors just to consider. It doesn't necessarily mean that the company won't recover or that it won't be profitable, but as investors, we aren't just looking here for yield. We also want to see that when we do make an investment over the last 10 years, even with our total return, we want to see it to be positive. So this is something just to consider with any investment, not strictly related to AT&T, although I do believe it does apply. Now we see it has a borderline safety score of 60, market cap of 116 billion, making it a mega cap company. Now in terms of some key recessionary metrics, well, they did increase the dividend during the 07-09 period. They had sales which was relatively flat, remember, above the average growth. As for the S&P 500, it was negative. And they did beat the S&P's negative 55% return, coming in at negative 45. Still negative, but that was for the majority of stocks during that period. Now we do see no increase since March 2022, with a negative 11% per year on average increases, with over the last 20 years at 0%. So very slow, not what you want to be seeing just because a company, remember, is offering high dividends or high yields. You shouldn't always believe that it is good, especially if you aren't even keeping up with inflation, which is around 4% over the last 40 years. Now, in terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So what we see here is roughly in line, 6.86 versus 6.81. So we have our sign of reasonable valuation. Although the forward PE tells us some slight undervaluation, given we see it sit at 6.6 versus the 5-year average of 8.6. Now the sector PE is significantly higher at 18.8, with AT&T's PE coming to 6.6, and it is trading towards the mid to lower end of the 52-week price range. Now in terms of the free cash flow payout, which is what we focus on, earnings susceptible to manipulation. So what we do see below 70%, we do bring this higher for telecoms and the industry. For the large part, it has been below that. 2022 at 64%, 2023 expected to come lower, which is positive. It does give me faith that that dividend will still be paid for investors. Free cash flow per share, somewhere that they have slightly struggled to keep consistent increases year on year. 253 in 2013, 173 in 2022. Now it has been going down. We would like to see this go up, but it is positive to see that 2023 it is expected to go up to the mid 2s to the high 2s. So that is positive to see as an investor. Sales growth, now yes, because of that Warner spin-off, we do see the negative increase, or the negative decrease in fact here. Prior to that, we do see 3 to 7% on average, which is what we do aim for in any company that we invest in. And in terms of sales, like I said, it is slightly difficult to be able to compare, but 129 billion in 2013 and 121 in 2022. Shares outstanding, now this is another negative of the industry. Typically, what we love to see is when companies do share buybacks, returning excess cash to our pockets, where we see this come down, declining. 5.39 billion in 2013, 7.17 billion in 2022. So they do dilute your position as a shareholder by issuing shares. Now, ROIC, remember 10% or more is what we aim for. It gives us faith that management are able to effectively allocate their capital. For the large part, they haven't really succeeded in that, although we do see 21 and 22 climbing up, so we would like to see that around 10% for 2023. Both margins seem to be reasonable. Operating margin 14% or more consistently, likewise the free cash flow margin. So that is positive news for investors as long as that does continue. And the net debt to EBITDA, remember this does affect that dividend safety. It's essentially the net debt to earnings before interest, tax, depreciation, amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. Now 2022, right at that threshold that we like to see at 3.5 and no more. 2023 expected to come down, so that is positive if they do manage to bring that down, as that will relieve some of that dividend safety stress that we see with a score of 60, making it borderline safe right now. So that is the analysis. Now jumping into the stock valuation. Remember, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio and acceptable buy price, do click on that pinned comment below. So jumping onto the first model or the first formula, we have Graham's valuation formula with our stock ticker. Now earnings per share. Now the trailing 12 months for 2023 is negative 1.15 as we see was 2021. So we have effectively gone for the average of the last 3 years just to be clear and transparent to the viewers. Now the growth rate is 24 per analyst estimates with that current yield on AAA corporate bonds, giving an intrinsic value of just under $22. Now when we take a look, that is slightly lower than the 52-week high, showing signs of undervaluation in the current market. Just remember though, we're not looking at any of these models in isolation and drawing our conclusions towards the end of the episode. Now, we would typically use this model, the multiples valuation model. However, we only have one real company that we can compare to Verizon. And as we can see, if we were to use this model for AT&T, we get a stock price of $6.25. Typically, we like to use a minimum of 3, 4 if possible in the multiples valuation to have an accurate essential valuation of a company. So moving on to the second model, which we're using, the dividend discount model, and we see that dividend cut. So the average growth rate at negative 8%. Now, forward looking before that, we can see around 2% increases. So we have gone forward looking at 2%. There will be investors who will be looking to increase that if they're more optimistic, or if they're more pessimistic to decrease that. Remember, if you grab a copy of the model in the pinned comment below, you can play around with the percentages. So this gives a DDM price of $19. Now again, it shows some nice upside to the current trading price at around 20%, but slower than that 52-week high. We then move on to the DCF model where we have the free cash flows year on year. Average growth rate of 5.4% with analysts estimating between 3 to 4% forward looking, so we've gone slightly more conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, divide by shares outstanding to get a DCF price of $21. And when we take a look, that is towards that 52-week high, again showing signs of undervaluation. Now remember, the intrinsic value is the average of these 3 models that we have gone through, and for AT&T it is coming to $20.66. Now remember, if you do enjoy the content, value is being provided, do hit that like button, do subscribe, and hit the bell to be continually notified of these videos as they drop. So remember, 10% margin of safety is what we'd start with if we believe it to be a strong buy. Well, the reasons for that would be wide moat, strong financial metrics, good forward-looking data. Now for AT&T, I would imagine you'd be looking at a larger margin of safety. 20% it would be a buy at 16.52. At 25% it would be a buy at 15.50. So right now you are looking at a 20% margin of safety. Now it does look to be a reasonable buy right now with a 20% margin of safety, but the reason for selling is essentially, as we can see, there are a few items within the metrics that we saw in terms of their lack of sales growth, lack of growth for the free cash flow, as well as a low ROIC, which is what we like to see at 10% as a pure minimum. And on top of that, they do have a significant amount of debt. Now, just because I'm selling AT&T, it doesn't mean that that is the right call to make. Investors will have different reasons for investing in different companies. And whilst I do believe that right now it isn't the worst stock to hold, I do believe there are significantly better opportunities out there which have a lot better growth prospects for the future. But again, that does come down to individual investors' preferences. A lot of investors may be purely looking for the dividend income and maybe looking just to purely buy AT&T for that 7% yield. And there wasn't anything from when we analysed that I would say particularly raises a red flag at that dividend safety, as long as they keep that net debt to EBITDA under control. So as always, investors do have different reasons for investing in different companies, but personally, this isn't a company that I would like to back for the foreseeable future, while I see there be a ton of other opportunities right now. Now, in terms of Wall Street, well, what they forecast over the next 12 months, they again do believe there to be some nice upside, roughly in line with our intrinsic value at $19.82. As always, let me know your thoughts in the comments below. What would you advise to use that money to invest in the current market? Do you see any other opportunities? Or do you believe that AT&T is a strong stock to hold now? Or if you're an AT&T investor yourself, are you looking to add more or even looking to sell? As always, if you enjoyed the content, do hit that like button, do subscribe, hit the bell so you're continually notified of videos as they drop on the channel. And finally, if you do want to grab a copy of the intrinsic value calculator to get to your own acceptable buy price and margin of safety of companies in your own portfolio, do click on that pinned comment. As always, have a great day, catch you on the next episode and take care.